Hi guys, and welcome back to the YouTube channel. In this video, I'm going to give you a simple hack that you can use for your limited company that's going to help you pay less in tax when you take dividends out of your company. So a lot of people still don't know this, even though I feel like I've been rambling on about this for years. But when it comes to setting up your limited company, you need to make sure you do it in the right way. And by this, I mean not just an ordinary off-the-shelf company as you usually would. What you need to do instead is get bespoke articles of association so that they work in your favour from a tax perspective, and also you've covered yourself from a legal standpoint. So from a tax point of view, what you can actually do is change the articles of association to have different share classes, and then you can change the rights on each of those shares. I know we're sounding technical so far, but stick with me here. You can change those rights to basically have different income rights or dividends, capital, voting rights, and each of these are going to have different tax consequences. So the great way we use this is especially the classic clear-cut case of a husband and wife tax planning. So quite often you might have a husband who's a higher rate taxpayer, they might have other income, other properties in their own name, or a wife that basically isn't working, staying at home full-time, looking after the kids and supporting the family. But what they've gone and done, and their previous accountant, or well, their accountant, not their tax advisor, hasn't told them about this, is basically that they've got their company set up wrong from a tax point of view. They've got an ordinary company and they've said, okay, yeah, let's give your wife some shares in the company, pay her dividends, that's tax efficient. And to some part it is, but actually what they're doing there is they're not using it to the fullest advantage. So with dividends, they have to be paid legally in proportion to shareholding. So in that case there, say for instance, we were taking a £50,000 dividend out of the business. If Mr. A and Mrs. A owns that company 50-50, 25,000 of that would be taxed on him, and then 25,000 would be taxed on her. The problem there is that, say for instance, Mrs. A has all of her basic rate band available, then actually there's 25,000 being taxed at a higher rate, when it could actually be taxed at a lower rate. So there, the tax difference between the two is significant. So what you want to do here is make sure that you get your articles of association changed, so you have different share classes that allows for this. And also this can be done at the time you set the company up, or when the company is already established. It's relatively straightforward to do, and by that I mean for a professional, you can't do this kind of stuff yourself. It costs, our fees to do this are about £500, and then for this you get your company changed, and then you get this tax advantage going forward each and every year. So as it stands at the minute, that £25,000, they'd be taxed at the higher rate. Whereas if you were to have this as basically the alphabet shares, they're called, that full 50,000, you wouldn't declare any shares, declare any income, any dividends on those original, say, Class A shares that are held by Mr. A. Actually, they'd all go to the Class B shares that are held by Mrs. A, and then benefit from her basic rate band, her personal allowance. We might give Mr. A £2,000 worth of dividends to use his tax-free amount up. Just by doing this in one single year alone, by having £25,000 taxed at the basic rate, the 8.75, rather than being taxed at the higher rate, the 33% rate, there's actually a £6,250 saving by having this arrangement set up where you're a higher rate, one of the spouses, one of the business partners, a higher rate taxpayer, the other is a lower rate taxpayer. By having this flexibility over how you pay dividends, the savings, £6,000. That's not a one-off saving, that's each and every year for the lifetime of your business. So actually, the cost to get this set up right from day one really pays for itself many times over. There's other things you can do as well with these shares, so you can change them. So if you looked at freezer shares potentially, if you've got an existing company, you can change the rights so that different shareholders have future capital rights. That is where it gets a bit more complicated and there's a lot more considerations to it. But here is a fantastic and pretty simple way to actually change your company so that it's more tax efficient and saves you tax. Hope you found this video useful. Please do give it a big thumbs up and make sure you subscribe.